So you can take a minute or so to have noted down that question 2b, and then we start solving it. Once you are ready, kindly notify me so that we start solving it.
Tony.
Yes.
Excuse me, kindly illuminate your work. We can't see properly.
Okay. So I've shared the same question to your WhatsApp. For those who are not able to view it appropriately, we can refer to the link I've sent you on WhatsApp. Confirm received. Want to handle question 2b from that particular paper. So in the question I've shared is what we want to try and solve. So the question of Uwezo Limited intends to issue additional funds as follows: 100,000 ordinary shares, that at 20 shillings each, 50,000 10% preference shares at 10 shillings each, then 40,000 10% debenture at 100 shillings each. And the market values are ordinary shares at 30 shillings. Flotation fees is 2 shillings per share. Then preference shares is 12 shillings. Flotation fees is 1 shilling per share. Debenture is 90 shillings. Flotation cost fee is 5 shillings per debenture. Required. Calculate the weighted average cost of capital of Uwezo. So we start off with ordinary share. I had given you last time, formula last time, and for ordinary shares I said KE is equals D1 divided by P naught minus F. P naught minus F. Then plus G percent. plus G percent. So let's try and see. And okay, for this formula, for the purpose of those who are not there when we are discussing, the purpose of those who are not present when we are discussing, we said KE stands for cost of equity, where KE is cost of equity. Cost of equity. D1 we said is dividend. D1 we said is dividend. And then P naught we said is the price per share. Then G percent is growth rate. G percent we said is growth rate. So let's identify those figures and substitute. From the question, who can remind us the dividend? Dividend per share. Anyone to remind us the dividend per share? Anybody who has identified the dividend? Hello? So, so for this particular question, because D1 dividend is not provided, so we'll use it as null. We'll use it as 0. Then P, price per share, we have been provided with that's 30 shillings. P naught. Flotation, we have been provided, that's 2 shillings. Then growth, which is a percentage, we'll have to compute. So for us to compute growth, because the share was initially at 20 shillings and is now going to 30 shillings, so in that case we'll have 10 divided by 30, then times 100 to get the growth. Who has the answer to that? 10 divided by 30 times 100, what's the answer to that? Anybody with an answer? 10 divided by 30 times 100, what do you get? Hello, are we there? Can you hear me?
Yeah. You say 10 divided by 30 times 100.
Yes.
33.33.
33.33%. So, in that case, we can substitute now in our formula. So from our formula, we'll have 0. We will divide by P, which is 30, minus flotation, which is 2. Then the answer we get there will add to 33.33. So, okay, this figure for this one will multiply by 100 to convert into percentage. Because the growth rate is on percentage, so we'll multiply by 100 to get into percentage. So, who can get us the figure? 0 divided by 30 minus 2 times 100. Yes, what's the answer? Nancy, Francis, Moranga, Joy.
Is
Yes,
33.3%.
the answer we will get is 33.3%.
Yeah.
So now that will be the cost of, or 0.3%. That will be the cost of ordinary share. So from this share capital, from this question, after ordinary share, we had the preference shares. Now for preference shares, as I also given you the formula, KP is equals DP over P naught divided by P naught, and then times 100, times 100 to convert into percentage. So let's and I said KP is cost of preference shares, DP is dividend on preference shares, and then P naught is price on preference shares. So let's identify that from the question. Anybody who has seen the price on preference shares or dividend on? Yes,
Question first. Where is this 100 coming from?
that 100 is to convert into percentage.
In the ordinary shares, not the.
In the ordinary shares. Okay, let me go back. Now, in the ordinary shares, we said the cost of N is dP over P naught minus F, then plus D. This D is in percentage. So in that case, we also need to convert this figure we are doing times 100 so that we convert into percentage. And then we'll have them on same format of figures so that we can easily add. Is that clear with you, Rebecca?
Thank you, I get it now.
Yeah, okay. So we can do for preference shares. So we have done DP. So we are looking for DP. That's cost of DP is a dividend on debenture, dividend on preference shares. Anybody who has seen that? Anybody who has seen the dividend on preference shares from the question I've shared? Now, or for me, in interest of time, because for preference shares you have been given a percentage, then that percentage becomes the cost. So we do 10% of 10 shillings. Yes, Rebecca? Rebecca?
Oh, sorry.
Yeah. Okay. So I was saying that for preference shares, because we've been given a percentage, we apply that percentage. So in this case, we have 10% of preference shares. So we do 10% of 10 shillings of price per share. Remember, when you are computing cost of capital, we are interested on a per unit, not the total amount that was collected. So we are doing per share. So in this case, we do 10% of 10 shillings because one share is selling at 10 shillings each. So that will be how much? 10% of 10 shillings? Anybody who has the answer? Ten shillings of 10%? 10% of 10 shillings?
One.
One.
That's one. So DP is one. Then we go to P naught. P naught is a price per share. So we'll go to the question to identify the price per share. So on the question, preference shares is 12 shillings and flotation cost is 1 shilling. So in that case, the price, the amount of money we are going to collect from the preference shares, 12 shillings. 12 shillings. So P naught is 12. Then now we can substitute in our formula. So in that case, that will be 1 divided by 12. And then we multiply by 100.
So I
No.
got lost.
Yes, Rebecca?
I got lost in the identifying the D. Is it DP?
DP?
Yeah, the
DP is
difference.
dividend per of preference shares. So the formula for getting the cost of preference shares is KP is equals DP divided by P naught times 100. So, and I've said the KP is stand for cost of preference shares. DP is dividend on preference shares, and P naught is price on preference shares. There's something to note. Something to note here. For for equity or ordinary shares, with less cost from the flotation cost. But now here, when it comes to preference shares, we deal with the price, then we also deal with the dividend. Dividend. So we have done 1 divided by 12 times 100. What's the answer?
8.33.
8.33.
8.33%. That's percent. Then we move on. We move on now to do the cost of debenture. And the cost of debenture, the formula I gave you is KD. KD is equals I into brackets 1 minus T close the brackets PAR then divide by D naught times 100. Who can remind us what I stand for? I had given you this formula previously. Who can remind us what I stand for?
Constant.
I. What does I stand for? A constant is 1.
Interest rate.
Interest rate, thank you. And T stand for?
Tax rate.
Tax rate, yes. And PAR? PAR?
Face value or market value of debenture.
Yes, of debenture. Then D naught?
Price for debenture.
Then times 100. So we can substitute. Let's get I. What's in the interest rate on debenture? I T PAR. Then D naught. Let's get those values, then you substitute in our question. What's in the interest rate on debenture? Interest rate on debenture. And what's in interest rate on debenture? Can we check on the question? Yeah, 10%. Thank you. It's 10%. So I will be 10%. Then we go to T. What's in T? What's in T? Tax rates. Now for this question, it didn't capture tax rate, debenture, and rotation cost. It didn't capture tax rate. So now, if it hasn't captured tax rates, they usually recommended the corporation tax range between 25 to 30. It's either 25 or 30. So you can use either. So for the purpose of illustration, let's use 30. Tax, we'll use 30%. 30%. Then PAR, what was the face value of the knee? PAR, that was the price. And check at the top, the debenture was valued at 100 shillings. That was the PAR. So we have PAR as 100. And then now we look at D notes. So D notes is 90 shillings. 90 shillings. Have you seen 90 shillings? No one who has not seen? If you have not seen, you can ask. So let's substitute. So I, which is 10%, which is 10%, we open the bracket, 1 minus 30%, 30%, then over 100, then divide by 90, then we multiply the whole figure by 100 to convert into percentage. Now, look at it this way. 10% it's a percentile, 1 is a whole number, 30 is a percentile, and then in that case, we need to convert these numbers into same format. So in that case, I would recommend we convert them into decimal. So to convert them into decimal, 10% will be equivalent to 0.1. 0.01. Then we open the brackets. 1 minus 0.03. We close the bracket. Not 0.03, 0.3. It's 0.1 minus 0.3. 0.3. Then we multiply by 100. And then we divide this figure by 90. Then again we multiply by 100. Whole thing we multiply by 100. So let's open the bracket. That will be 0.1 times, if we open the bracket, it will be 0.7. 0.7. Then we multiply by 100 and divide it by 90. And then the whole figure, the whole thing will multiply by 100, convert it into percentage. So I have simplified this. You can place on your calculator, then you multiply by 100. Place it on calculator, then let's see the figure we get. So anybody who has the answer? Anyone who has the answer?
Is it 7.78?
Yes, thank you. 7.78. So 78%. It's a percentage. So now what we have done, so far we have calculated the cost of capital. But remember, the question was not asking us just to calculate the cost of capital. The question was asking us to calculate the weighted average cost of capital. Now, for us to calculate the weighted average cost of capital, I will insert here a table, then we fill in. Weight So I will insert here table, and the first column will record the source. The second column will record the amount, and then the third column will record weights. Then record weights. Then we'll record costs. Then we'll record weighted average cost of capital. Weighted average cost of capital. So the first source, we had equity. Equity is also, we said, it's also called ordinary share capital. Then we had preference share capital. Preference share capital is also called quasi. Then we had debenture. Debenture. So we fill in the amount, then we have total. We fill in the amount from the ordinary share capital, how much had been raised. So to find out how much was raised under ordinary share capital, we do 100,000 times 20, because the price was 20 shillings, so we multiply by that. No? Okay, the share was sold at 30 shillings. The share was sold at 30 shillings. So we do 100,000 times 30 shillings. So how much is that? 100,000 times 30 shillings.
3 million.
3 million. So we record here under the amount 3 million. So we go to quasi. Quasi is a preference shares. So preference shares were 50,000 shares, and they were sold at 12 shillings. So 12 times 50,000. 12 times 50,000.
600,000.
So we come here and record 600,000. We go to debenture. So debenture, they sold 40,000 debenture, and they were sold at 90 shillings. So 40,000 times 90. 40,000 times 90.
3.6. 3,600,000.
3,600,000. So now, can you add to get the total capital that was raised? That's 3 million plus 600,000 plus 3,600,000. What's the answer?
7.2. 7,200,000.
7,200,000. Now, for us to get weight, we divide this amount against the total. So, for example, for us to get the weight for equity, we divide 3 million divided by 7,700,000. 7,200,000. Divide 3 million divided by 7,200,000. What do you get?
0.42.
0.42. I will advocate we use 4 decimal places. Let's use 4 decimal places. So it will be 0.42. Ama imeisha hivyo?
Itakuwa 0.4167.
4167. Okay, I will show me. Let's compute, and then I'll tell you why I recommend 4 decimal places. Let's do for Kwasi 600,000 divided by 7,200,000. Mm-hmm.
0.0833.
0.0833. We move on. The fourth one, the third one, 3,600,000 divided by 7,200,000.
0.5.
0.5. Okay. So, so that I will explain to you, you are able to get why I have recommended us to use 4 decimal places. Kindly add these values and get the answer. Kindly add those values under the weight. Under the weight.
One.
1. Thank you. So when you add that value, you should get either 0.99 up to 1. If you get 0.999 something up to 1.00, that means you are correct. But if you use 2 decimal places, you are likely to come up with a figure that will be either 0.98, of which will be far-fetched, 0.98 will be far-fetched, or you are likely also to get to a figure that like 1.01 or 1.1, or yes, 1.01. So in that case, that's exaggerated. You should get either 0.99 or 1. That means okay. So if you use 4 decimal places, you reduce that error rate. So that's why you are likely to arrive at exactly 1 or closer to 1. So now cost, we insert cost the way we have calculated. For example, the debenture we had calculated to get, we got 7.78%. But now because our weight is in decimal, we also convert that into decimal. So that will be equivalent to 0.0778. Now for Kwasi or the preference shares, we had gotten 8.33. So 8.33 is equivalent to 0.0833. Then equity, which is the ordinary share capital, we have gotten 33.33%. 33.33%. Sorry, 33.33%. Now, if you convert to decimal, that will be equivalent to 0.3333. Now, what we are interested in to find weighted average cost of capital. Because we are interested in get a weighted average cost of capital, for us to get it, we'll do weight times cost. I'll repeat. For us to get weighted average cost of capital, we'll do weight times costs. Weight times cost. Now, for example, for ordinary share, it will be 0.04167 times 0.3333. What's the answer? Who has the answer?
Zero point 0.14.
0.14. So we move on to the, okay, we'll move on to the second one. 0.0833 times 0. This one was more or less same. The weight and cost is same. Multiply 0.0833 times 0.0833. What do you get?
0.007.
007. We'll go to the last one. 0.5 times 0.00778. What do you get?
0.04.
0.04. Now, add these values under weights. Add those values under weights. And add those values under weights.
That's 1.
Yeah? I've gotten the figure is 1. Hello?
Zero point 0.0648.
0.6048.
0.0648.
0648. So now, this figure you have given me is what we have been looking for. This is what we are calling the weighted average cost of capital. So we can convert it into percentage. If you convert it into percentage, how much, what will you get? If you convert that into percentage, what do you get?
Sorry, why am I getting It's different.
Rebecca, you are getting different
The
figure?
value, I'm getting 0.187.
Yeah, same.
0 point?
Same.
0.187.
0.187. Somebody else who has a different figure?
Finance wamechelewa kutafuta, hata leo nilikuwa nafuatilia. Most likely tutakuwa na jibu kesho.
Alexander, kindly mute. Anybody who has a different figure? So we go with the figure of 0.187. So convert this into percentage. If you convert that will be 18.7%. 18.7%. So 18.7% is what we have been looking for, which is the weighted average cost of capital. This is the average cost of capital that this company is paying, though it's paying different rates at different sources. So let me get you another question. We do, then we move on to the next topic.
I have a question before we move from there.
Yes, go ahead.
How are you getting the weight? Kuna vile nilikatikwa na net. How are you getting the weight?
The weight we were getting, we got the total. Just a minute, I'll get back to. Yeah. Now, for us to get weight, first of all, we got the total, this amount. We got this total. After getting the total, now for us to get weight, we divide. For equity, we have 3 million. So this 3 million we divide by the total amount. Then that ratio that we get is what your reference weight. When you go to Kwasi, it's 600,000. We divide by the total amount, and that's the figure we get there. For debenture is the same thing. This amount we divide by the total. Then whatever we get, that's what we record there. Is that in order?
Yes, thank you.
You're welcome. Any other question as I get you another paper we try?
And for the weighted average cost
Of capital. Yeah?
Yes.
Yeah. Now, for us to get the weighted average cost of capital, we multiply weight and costs. We multiply weight and cost. So, for example, for equity, we did 0.4167 times 0.3333. Then we go to Kwasi, we do 0.0833 times 0.0833. Then for debenture, we do 0.5 times 0.770778. That's in order with you?
Yeah. Thank you very much.
I have a question.
Go ahead.
When we were calculating the ordinary shares,
Yes.
we did this growth rate. So there was this formula 100 divided by 30 and then multiply by 100. Like this
Now,
first
okay.
one, where was it from?
Now, because we had not been provided the growth rate, the expected growth rate, so we had to estimate. So in some questions, we are usually provided the growth rate. So if you have been provided the growth rate within the question, then you use what has been provided. But now, because in this case we had not been provided, that's why we had to estimate.
The estimate was 100.
No, the estimate was not 100. 100 was to convert into percentage. The
This
share
was
was
100.
the share from the question was 10 shillings, 20 shillings rather. And now the price that we had been given under additional information was 30 shillings. So the difference was 10. So that difference of 10, what we divided by the market price, which is 30, and now multiply by 100 to convert into percentage so that we see at what rate has it grown, because the growth rate must be in percentage form. Is that in order?
I get it now. Thanks.
Okay, welcome. So I've sent you another set of questions. And I would like us to try number 6B. I'd like us to try number 6B. So once we do this 6B, we can move on to another topic or another area of discussion. Can I give you a minute or so? You note it down. Allow you a minute or so. You note it down for those who are writing, or for those who are using the same gadget, so that you are not confused. So I'll allow you maximum 2 minutes. Note it down as I take a cup of water.
Wamesema tufanye question gani baadaye? Hello?
6 ama
Which
ni
question
6?
number 6?
Hebu watu wa confirm ni namba.
Ndio amesema 6 lakini 6 ni different.
Amesema 6B.
6B. Si ni ile ya present value for project X and Y ama hiyo ni gani?
Ni hiyo.
Yeah, see related to this concept, si ni ile ya kitambo tulifanya.
Hello, I'm back. Confirm you have noted down that particular question. We start solving it. Hello, confirm if you can hear me. We start solving.
Can hear you.
Okay, so we go back to business. So this question is again asking for weighted average cost of capital, and it has 4 sources. Now this one has 4 sources. It has ordinary share capital, it has retained earning, and it has preference share capital and also debenture. Remember, there are only 5 sources of capital. So the only source that we have not looked at is loan after we have done this. So the only one which will have missed is a bank loan. But now the bank loan, the form, yes,
Which
yeah,
question is that?
number 6B. Have you sent on WhatsApp? Confirm.
B.
6B.
It's a
B
different
is talking
question.
net value,
Yeah,
like
yeah,
NPV.
yeah.
It's talking about NPV.
NPV. Just a minute. Oh, that means I sent the same question you have solved.
Yes.
Sorry, sorry. I sent the same question you have solved. Let me send another one. Hmm? Confirm I have received. Confirm this. Confirm if it's legible. Have you received? That's 6B.
Yes.
And but B, I've taken a photo because I've seen a machine I'm using has a default to open a PDF. That's why I'm not able to categorize. So on this particular one, and I was saying it has four sources. It's an enhancement. It has at least four sources. That's for ordinary share capital, for retained earnings, for preference share capital, and for debenture. So we'll do the calculation, and the required is calculate the weighted average cost of capital. Calculate the weighted average cost of capital. So now, similar way, we start off by calculating the cost of capital. So we start by calculating cost of capital. And since the first one is ordinary share capital, we'll go to ordinary share capital. KE is equals D1 over P naught minus F. Then we'll multiply this by 100 to convert into percentage. And then we'll add plus G, and G will always be in percentage. So let's identify D1. Anyone who has seen D1 from the question? P naught F F, and then G percent. Let's identify those values, then we substitute. Anyone who has seen D1 from the question?
It's 6.
Yeah, it's 6. Okay, so D1, yes, thank you. It's 6. We write there 6. P naught, price per share. Price per share.
Should be
Anyone
50.
who yeah, 50. Thank you. 50. Then we go to flotation cost. Do you have flotation cost? Flotation cost, have we been provided?
Nope.
No.
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 If you have not been provided, then flotation cost will be 0. I will also give an explanation to this. Now, whenever we are calculating the cost of capital, at times we could be calculating the cost that is being raised today. And at times we can also calculate the cost of capital for the company that has been in existence that has not raised any additional capital in the recent, in the near future. So, for example, the last time a company like Safaricom, when they raised capital through sale of ordinary shares, that was in the year 2008. So since then, they have never raised another shares, another capital through sale of shares. So that means they paid the flotation cost in 2008, but they continuously keep paying the other costs. So in that case, they still have the cost of they still have cost of ordinary shares. But now in this time, they are only paying dividends and other costs. So in that case, that's why flotation cost is likely to be 0. Now, do you have growth rate? Anybody who has
Yes.
growth rate?
Yes.
How
15.
much? 15%. 15%. So we have now all the values we can substitute. So we see D1, which is 6, divided by 50 minus 0, then we multiply by 100, multiply by 100, and then we add 15%. 15%. You can place on your calculator and give me the figure. What's the answer? What's the answer?
$12.15.
Yeah, 12 points.
15.
Hmm?
15.
No, it can't be 12 because there's 15% already. Growth rate is 15%. So if you add, you can't get 12. You can't get less than that.
It's 15%.
Huh?
It's 15.
Really? It can't be 15 because let's do together 6 divided by 50. Okay, 50 minus 0 is still 50. Then we multiply by 100. You get 12. Then that 12 is what you are adding to now 15 plus 15. 12 plus 15. What do you get now?
27.
27. So that's the cost. 27%. So we move on. We go to the second one is cost of retained earning. Now, cost of retained earning has a formula similar to cost of equity. Save it for the growth part. Save it for growth part. So KE is equals D1 divided by P naught minus F, then we multiply by 100. So for retained earnings, we don't add growth rate. We only calculate that cost of, we need the way we calculate the cost of equity without adding growth rate. So in that case, we already have these figures. We have D1, which was 6, divided by 50, P naught was 50, minus flotation cost was 0, then you multiply by 100. Calculate and give me the answer.
12%.
12%. Thank you. Then, Rebecca, it seems you are logged into 2 gadgets. You could have been logged on using a laptop and logged on. That's why when you talk, there's a lot of echo. You can log out with one gadget and use the other, or you can mute one so that when you talk, you just talk with one gadget.
Thank you. I've
Thank you. Okay, welcome. So the answer we get is 12%. 12%. So we move on to the next one. Next one is the cost of preference shares. The cost of preference shares, the formula is still KP is equal, KP is equal P naught dP over P naught times 100. dP over K over P naught times 100. So we look at dP. What's the dividend on preference shares and what is the share price? Who can identify the dP, dividend on preference shares? Dividend on preference shares. Hello, class. Are you able to identify the dividend on preference shares? As we did last. Somebody has identified? It's 12% of the price, because we have been provided in percentage, so it's 12% times the price. The par value is 20 shillings, so we do 12 times 20. What do you get? 12% of 20. Hello, class.
You get 2.4.
2.4, thank you. So DP is 2.4, and P naught is how much price? What is the market value per share? Market value for preference shares. Anyone who has seen market value of preference shares?
25.
25. So now let's substitute. Is 2.4 divided by 25. We multiply by 100. So what do you get? 2.4 times divided by 25 times 100.
9.6.
9.6%. 9.6%. So we are doing well. We progress. So we move on to the last one, and the last one is now debenture. And the debenture, we still use the same formula, KD is equals I. Let me just copy the formula because it's here. So let's identify I in the question. Identify I, somebody to be identified T, somebody to identify PAR, then another person to identify D naught. Who has I? I is interest rate. I is interest rate. What's the interest rate?
30.
Interest rate, no, it's not 30.
Oh, 10.
It's 10. Interest rate is 10%. So that's 10%. We move on to T. What's identified T?
30.
T is 30. T is 30. 30%. PAR? PAR? Par value? Par value? Anybody who has seen par value? This was the simplest because it was indicated directly.
1,000.
Yeah?
1,000.
1,000. Then the price. Anybody who has seen the price? Who has seen the price? Market price of the debenture. Anybody who has seen that?
500.
1,200. So we have identified the figures. Now want to substitute. So interest is 10%. Into bracket, we open the bracket. 1 minus 30%. 30%. We close the bracket. Then we multiply by 1,000. Then we divide by 1,200. Then we will multiply by 100. 100 years. So the same thing we did, because we have percentages, these are mixed figures, we have to convert into decimals. So we have 0.1 into bracket 1 minus 0.3. Close the bracket. We multiply by 1,000. Then divide it by 1,200. Then multiply by 100 to convert it into percentage. So we can simplify it further. That will be 0.1 times 0.7, and then times 1,000, then divide by 1,200. We multiply by 100. You can place on your calculator and get us the figure.
It's 5.83.
5.83%. So we go to the last part. The last part we add this table. We add this table so that we can fill in. So insert a table. So the first column will always have source. The second one will always have amount. The third one will have weight. Cost. Then the last one will have weighted average cost of capital. So we start. The first source was equity. The first source was equity. The second source was after equity. We retain earnings, then the preference shares. Retain earnings. Retained earnings is also called retained profit. In other books, we also refer to it as retained profit. So that's the undistributed profit. Then we had preference shares. Preference shares. And then finally we had debenture. Debenture. So we fill in the amount. The amount for equity will cost say. And now this is beautiful. Now we don't have to adjust. For this particular question, they had already given us the figures. So we fill in the figures they are. Equity is 10 million. Then earnings 12 million. So it's 10. Then this one is 12. Then for preference shares is 4.8, then 7.2. So then 7.2. I hope I've not lost anybody. So get a total. A total we had already been given from the question. So this one was easy. 34 million. 34. So now we want to get weight. Now for us to get weight, we said we divide, like for equity is 10 million divided by 34 million. Who has the weight for that? 10 divided by 34. Who has the weight in 4 decimal?
0.29.
4 decimal, please. 0.
2941.
0.2941.
2941. Thank you. We go to obtain earning 12 million divided by 34 million. 0.
0.3529.
529.
0.3529. We move on to the preference shares. That's 4.8, 4,800,000 divided by 34 million. What's the answer?
0.1412.
1, 2. We go to the last one. The debenture, 7.2 or 7,200,000 divided by 34 million. 0.2118. 18. Thank you. You can add this weight for just clarification. Remember, I said when you add, you should get between 0.99 to 1.0. So 0.99 to 1.0. So you can add for the purpose of clarity so that we confirm if we are okay.
You get 1.
1, that's perfect. If we get 1, that's perfect. That means we have reduced the error rate. Now, the cost. The cost, we insert the cost that we have calculated. So, like now, the last one was debenture. We had 5.83. 5.83 is equivalent to 0.0883. 583. So we are converting to decimal because the weight is in decimal, so that it's easier for us to compute. Then for preference shares, we had gotten the figure was, what was the cost of preference shares? 9.6. Yeah. 9.6. So 9.6 is equivalent to 0.096. Then retained earning, we had gotten 12%. So 12%, that's 0.12. Then the last one is equity. Equity, we had gotten 27%. That's 0.27%. So now, weighted average, we said we multiply weight against cost. Multiply weight against cost. Multiply weight against cost. Who's giving me the figure?
0.0794.
0.0794. The second one? The second one?
0.0423.
0.0423. The next one?
0136.
Come up again.
0136.
0.36.
36. Thank you. And the final one?
123.
123. Now let's add this value to get the total. Let's add those values to get the total. What's the total?
0.1476.
0.1476. Okay, thank you. Now we can convert this into percentage and say that our weighted average cost of capital is the equivalent to 14.76%. 14.76%. And so that's how we calculate cost of capital. So that marks the end of this particular topic on the source of funds, source of finance, and which you are culminated to calculating cost of capital. So before we move to the next area, I will entertain a question or two so that when we move, we are all moving together. Anybody with a question or concern, you are free to raise so that we discuss and move to the next part.
Yes, I have a question.
Yes, go ahead.
When you are calculating the cost of equity, the cost of ordinary shares,
Yes.
we were doing the D1 over DO. Why are
Over
we
P
not
naught.
sorry?
The cost of equity is we were doing D1 over P naught minus F.
Yes, and then we add the growth rate, right?
Growth rate. Yes, yeah.
So this D1, is it the one plus G? Because when I check at the notes that you had given us, they are saying that the equity is supposed to be DO1 plus G. Then now the rest is over PO minus F plus G. So why my question is, why am I not seeing the one in your formula?
The one D1. Okay.
No, like
D1. D1, that's the dividend. Dividend per share.
Yes.
Yeah, that's the dividend per share.
But my question is,
Yeah.
I'm seeing the formula that we are using right now to calculate. We are doing D1 over PO minus F, and then we add
Growth.
G. Ndio,
Yes.
yes.
Yeah.
But then if I try to compare this formula with what we have kwa zile notes ulitupatia, they are giving us DO 1 plus G, then over PO minus F, then plus another G. So yes, I'm confused. Like I cannot see this 1 plus G kwa hii formula tunatumia sahi.
Tumia hiyo ni tumefanya na wewe iko more simplified.
Okay.
I know. Okay, like we have calculated. For example, you'll find different books will also have different versions. For instance, when you are calculating cost of capital, I've shown you how to come up with the table because I know it's more simpler to conceptualize and be able to apply for even for exam purpose. But there are other books which will give you just a formula. You don't have to go through table. Yes, sir? Yeah.
Yes.
But I prefer the table one. This is more simplified.
Okay, thank you.
Is that okay? Welcome. Is there any other question that probably you can tackle before we move on to the next to another area?
Alafu naulizia kuna hii yenye ulikuwa umetuma ya flags hiyo number 6,
Yeah.
the other number 6.
Yeah.
Si utaweza fanya kidogo?
That was nini NPV. Okay, tunaweza ifanya though NPV we had done previously. I know some of you had missed. Can we do something we have not tried? Then we will create a session where we can please do a recap of all other areas, of like a revision. Would that be fair?
Sawa sawa.
Yes.
Okay. So I would like us to discuss about budgeting and budgetary control. Budgeting and budgetary control. That's an area where we have not tackled. To get to each page number so that you go. That's topic 6. Go to page 139. We discuss about budgeting and the budgetary control. Page 139. So, yes. Let me try and see if I can share it so that we read from the same page. So, budgeting, the definition of budgeting, this refers to a process of quantifying the plans of an organization so as to enable it to achieve its objective in the defined period. And the results of this process is a budget. So that means we have a process which we are referring to as budgeting. Now, this particular process, how we estimate the much we are going to earn against the much we are going to spend. So once you have estimated this particular area, then we come up with a product which we are referring as a budget. Now, once you have come up with a budget, then now we'll come up with the budgetary control. And the budgetary control is a process by which we exercise Okay, budgetary controls that now we are implementing this budget, and you have to take in consideration what had we estimated to earn. For example, in a business, you could have estimated that you will generate revenue of, let's say, 1,000 shillings, but you have generated a revenue of 700 shillings. So in that case, whatever you had also estimated to spend 800, that means you cannot spend that particular amount. So in that case now, that's why we come up with the budgetary control, that we come up with the mechanisms or processes how to put in control about the finances of a particular organization. Now, we look at the purpose why we have to come up with the budget. One, we come up with a budget for the purpose of coordination. Now, coordination in this perspective, within an organization, we have different departments. We have different departments running concurrently. So now, if we have a budget, then it means it's easier for us to coordinate. For example, marketing department can raise up one morning and say, we want to have a field day, or we are going for a field trip. Yet we are not planned. So finance will not be able to avail those particular resources. So marketing will blame finance for having let them down. Yet there were no plans. So if they had plans, it becomes easier. So marketing will just request for the monies that had been appropriated. Or still the procurement might intend, or somebody might request for a particular item from the organization. But now that item had not been planned. So that means you have to plan for it before you can purchase. So you don't just wake up one morning and say, today we are going to buy a new computer, today we are going to buy a new laptop. So you must have planned so that it's easier to coordinate. Another one, it makes it easier for communication. That if once you have a budget, it's easier for us to pass communication from one department to another. For example, if you are making a request as a procurement officer, you are making a request for a purchase, or you have received a request from a different department that a particular item is required, then when you have a budget, it's easier for us to pass communication. We can say, yes, we would like to supply you or to support you in that particular area, but now because of constraint, we are not able to supply you, or because of some reasons, we are not able to supply with that. So in that case, it becomes easier for us to pass that particular communication. Remember, when we don't have a budget, the employees, especially the support staff, the lower cadre, they will assume that management only declined to approve some of the requests. But now, when you have communicated to them that when you have a budget, it can become easier, because they will also understand this. No, it has not been factored in. Then it also enabled control, and control is a process of comparing actual results with the budgeted results. So we are able to control, we are able to assess. Remember, I gave you a scenario. You have a business and you estimated to collect a revenue of about 1,000, but you have only collected 700. So with that revenue of 1,000, you had estimated to also make a purchase or an expense of 800 shillings. But because you have only collected 700, you cannot go ahead and spend 800 because you don't have that 800. So in that case, you are able to put in control. You are able to check what can you leave out and what can you do. Another function, it also enable motivation. That if you were, assuming you as a procurement officer, we had a budget to buy a computer or a laptop. This laptop had been estimated to cost 80,000, but you have gone ahead and negotiated or gotten the best bid on the market, on best offer on the market, and you have bought this particular laptop at a modest figure of 60,000 or 50,000. That means there's a savings. So with there's a savings, you feel motivated because you have achieved whatever. And if you are to generate revenue, you are to generate 50,000 and you have generated 60,000, again you'll feel motivated because you have surpassed your target. So when it comes to expenditure and you have spent less than what you were to spend, we become motivated. If it comes to revenue and you have generated more than what you are to generate, again you become motivated. And then another is clarification of responsibility and authority. Within the budget, every department will have their accounting officer. So in that case, it becomes easier for us to assign those responsibilities. If we are giving money to marketing department, it's easier. We know who is the accounting officer within the marketing department, and we expect that particular person to bring the receipts or to account for every shilling that had been given. So it becomes easier. Then planning, of course, we use budget to plan. You are able to know how much are you likely to get in the near future against how much you are going to spend in the same matter. So let's look at types of budgets. Now, we have the major type of budget. We have what we are referring as a master budget. Now, a master budget, this is the main component, this is the main tool that organization will have, that will prepare once in a year a master budget. And this particular budget, it consists of all other small bits of budget. So we'll make it once, but it caters all across other sections or other parts of a department. So that's a master budget. Then within the master budget, we have some components where we have operational budgets. So operational budgets, those are the activities that are undertaken by organization. Like organization will do sales, will do production, will do direct material purchase, will do direct labor and all that. So those are the operational, what we encounter from day to day. Then we'll also have financial budget as part of the master budget. Now, this financial budget, these are what we are estimating, what we should get, let's say, how much money are we likely to raise as capital, additional capital, how much money are we likely to pay out as dividend, how much money are we likely to pay out or get, and all that. So those are the plans that we do and with the financial budget. Hmm? Then we have a functional budget, and a functional budget are prepared for an individual function. For example, if Kim today is organizing for a graduation, then we'll have a functional budget tailored towards that graduation. We'll estimate how much does a student pay for graduation, then how much are we going to pay to hire the ground for graduation ground, to get the gowns, to get the place set up, and all that. So in that case, we will be dealing with the functional budgets. So I'll let you read the usefulness and problems of functional budget. Then production budget. A production budget is usually expressed in a quantity and represent the sales budget adjusted for opening, closing, finished goods, finished stock, and work in progress. Now, when you talk of production, we are concerned about how are you going to produce this particular item? How much money are we going to incur for us to be able to produce this particular item? What are we going to incur in cost? Then, as we produce, there are some items which we will not have finished production by the end of the period. So we refer to them as work in progress. There are other items that might still be in process for production. So we will also recognize them. So that's an illustration, but we'll pay a key emphasis. There's a particular budget called cash budget. That's what we'll pay a major emphasis on it to prepare. So as much as there are this illustration of these other minor budgets, my key emphasis I'm concerned with, okay, we would like to look at the cash budget because it has a lot of adjustments. For the other budgets, they are more direct. They don't have adjustments, but we would like to look at the cash budget. So let me get a question. And the cash budget is expected receipts and payments of money for a given period. It shows the expected receipts and payment of money of a given period. So in this case, the cash budget, it takes into consideration how much money are we going to receive against how much money are we going to spend. Now, I've said that we'll give much emphasis on this particular budget and we do practical because most organizations, most entities usually suffer a lot because of not making profit but because of not managing cash. And I'll give you an illustration. If today you have paid money to Kim and you probably have paid money for tuition and Kim diverts the money and go and buy a motor vehicle. So That motor vehicle will be available, yes. But once you get to the end of the month, we'll expect to pay salaries, we'll expect to pay suppliers and other costs. We'll not have money to be able to effect those payments. So if we cannot effect those payments, then it means that we will suffer, or most of the suppliers will start withdrawing their services. So when they withdraw the services, then it will pile pressure to management, and at some point, that pressure might be higher than what management can accommodate. So if management fail to accommodate, then it might lead to closure of a business. And a number of businesses have closed because of that. So there's a format here, but now we look at, let me get a question on that, and we do it practically. I'll get a question from a past paper, then we do it practically. So just a minute or so, I download a past paper that has a cash budget, I circulate to you, then we'll be able to solve that particular question. Here, minute. Yes, I've gotten one here. Hmm. I'll send a question on WhatsApp. I've sent a question on WhatsApp. Kindly check. Go to question number 6 once you have received. Confirm if you received. Go to question number 6. Hello? Are we there? Hello, are we there?
Yes, yes.
You have received, eh? So
Yeah.
go directly to question number 6. Question number 6. Now, that question number 6, I'll request I'll give you some 1 minute, you go 2 minutes, you go through individually, then we go through together. It will be much easier. Then it will take us shorter period to solve that particular question. So kindly take some 2 minutes to go through it individually, then we discuss it together. We will go through it together and solve it. It's a very easy question. So, hello. I hope we are still there. Let's now go through it together. Can you hear me? Rebecca, today you have not talked to us.
Yes.
Yes.
Yes, I'm here.
Okay. Okay. So now, in simple terms, on your CV, have you written you are keen to details? Anybody who can confirm he has written on his CV or her CV, he is keen to details.
Pardon? Have written?
In your CV, have you written you are keen to details? As a selling point, you look into details of everything.
Yes.
Yes. Now, if you have written that, this question is testing us if you are keen to details. The answers are within the question, but now we only follow the instructions that you have been given. And I'll request any willing person or any volunteer who can read for us the question, then I'll give the interpretation. Somebody to read, then I give the interpretation.
The following information was extracted from the books of Malimingi Limited, a company which started trading 1 year ago. So we have the months for 2016, for the year 2016, starting from April
To December.
we have April to December, and then we have a next column for sales and the last column for purchases. For the month of April,
You can go to Nini, additional information.
the following addition information is available. For question A, cash 4.A, cash in hand at the end of May 2016 will be Kenya shillings 180,000.
So just a minute. Okay, we want to go with the point by point as I clarify so that once you have read, we start solving. Now, for this particular point, we say, okay, for the cash budget, to solve cash budget, we need to identify two particular parameters. Because from the definition, we have been told it entails cash in, the cash received, and cash paid out. So in that case, I would like to create here a table of cash received, and cash paid out. So the first item, the cash paid out. So the first item, which was balance, so that means the money that is in our account. So balance is always recorded as money we have. So you can read the second item, then we also look at it, what it instructs us.
60% of the sales proceeds are received in the current month, 30% in the following month, and the balance is received 2 months after sale.
Very well. Now, this is the second instruction is telling us about sales. So we have sales, and sales is we receive money in 3 installments. That under money received, we have cash sales, and cash sales is 60%. 60%. Then we have collection. For those new collection, the first collection you collect 30%, then the remaining amount, which is 10%, will also be collection. Collection of another 10%. Read for us another instruction.
Suppliers are paid 1 month after delivery of goods.
So that's money out. We have purchases, but we pay after 1 month. So we move on to the next one. Next item.
Corporation tax for 2015 amounting to Kenya shillings 20,000 will be paid on September 2016.
Yes, 30th. So in that case, we have corporation tax. That's money out. Corporation tax. Corporation tax. Then we progress.
Contractors' retention monies amounting to Kenya shillings 50,000 will be paid on 30th June 2016.
So that's money out. So contractor retention. So that means there's a contractor who had done work and the money had been retained. Contractor retention. Then we move on. Read for us the next one.
The shareholders, at their last extraordinary general meeting, increased the share capital by shillings 70,000 and the first call of shillings 40,000 will be received in October of 2016.
So that means that's money that's coming in. So we'll place here under money in share capital. Share capital. We move on. Read the next one.
In the October 2016, the company is due to receive shillings 20,000 as compensation for a civil suit.
So that's money that you are going to receive. So we record under, we record it civil suit.
Cash receipt. The monthly administration expenses amounting to Kenya shillings 33,000 include a factory depreciation charge of Kenya shillings 4,000 and a preliminary expense of 3,000 shillings.
Very well.
So a payout.
It's under money payout. And as much as it's under money payout, we are concerned about the transactions that are involved. The total amount is 33,000, but there's an amount which is paid for depreciation. Now, not this. When you pay for depreciation, yes, we consider it as accounting. We usually call it as accounting expense. There's no money that goes out. There's nobody will write a check that now this check of 20,000 is a depreciation of machine. We don't pay out. Or there's nobody will pay out cash, will give cash to say that this cash is now for this cash is for depreciation. So in that case, we don't consider that as when you prepare cash budget, we have to subtract that. Now, preliminary expenses, this is what is meant by it. For example, if you are running a business, you must have a business permit. Now, if you get a business permit, that means you have to pay the county government. And usually, if you have a business premise, your permit you only pay once in a year. So at the beginning of the year, you will pay, let's say, regarding the nature of the business and also the size of the business, they'll give you a quotation. So once you have paid out, it's not fair to consider that as an expense for that particular 1 month. You divide by 12 so that you deduct from your books of account in bits. So that's what you are referring to, preliminary expenses. But remember this, we are only dealing with the cash budget. We are only concerned about cash that has been received and cash that has been paid out. So we are not concerned about, okay, for that preliminary expenses is the money we deal with it on cash budget when we paid out. So we don't have to keep on recording it on monthly basis. But now when we prepare our income statements or our financial statements, we have to consider that we refer to it as amortization. You might have heard of the term amortization. It's an expense we have incurred, but we divide into small terms so that we utilize those money. So yes, read for us another.
Office equipment worth Kenya shillings 13,000 will be paid for the month of November 2016.
So that's an expense. Office equipment. Read for us the next item.
Required, prepare a cash budget for the period of June 1st to December 31st, 2016.
Okay, thank you for that. So we now want to prepare cash budget. Now the first item we have distinguished receipts and payments. So now these receipts and payments is what we are going to form the units in our account. This receipts and payment will form the units that we are going to record on our cash account. And now this, we want to prepare cash budget from June to December. So I will insert here a table. So we'll have details details. June, July, August, September. The beauty with the cash budget, once we do for 2 months, you will be able to apply the concept and finish up with the others. September, October, November, December. September, October, November, December. So under details, the first item to record, the first item is usually balance carried down. Balance brought forward, yes. Balance brought forward, BF. Then, once you have recorded the balance forward, just a minute, I convert this into the layout orientation to landscape. Landscape, so that we are able to utilize this space appropriately. After that, we'll have cash receipts. Cash receipts. Let me adjust my so cash receipts. So underline this because it's not one transaction. So you can underline. For me, I will change the color. Then under cash receipt, we had identified them. We had cash sales 60%. Just copy. So what we had identified, that's what we're going to record here. So we have this, we will feature here. We have this. Have this. Share capital. Have it here. Then a civil suit. So after that, we'll have total. Then we'll, after total, add more. Have cash payouts. Cash payout. So I'll also change, you for your sake, you can underline, but for me, I'll change the color. And under cash payout, we had identified them, had the purchases and all this. That's what we are going to bring it here. So the first one is purchase. The second one is corporation tax. The next one is contractor retention. Then after contractor retention, we have admin expenses. admin expenses. Then after that, the next is like office equipment. Office equipment. Then after that, we'll have total. And then after total, we'll have balance. Carried down. Carried down. So can I allow you a minute you draw that? A minute you draw that, we start filling in. Or are you comfortable we start filling in already? I'll allow you a minute, fill in, you draw it. Can we start off? Kindly confirm. I need at least 2 people to confirm they are ready. We start off filling in.
Yeah.
Okay. Francisca is ready. Another person who is ready?
Yes.
Okay, so we start filling in. Now, balance brought forward. We've, as you have said, we follow the instructions. Cash in hand as the end of May 2016 will be 180. That means when you start off 1st July, the balance that we had in our, we closed with, that will be the opening balance. So we come and record here that 180. 180. So we go to the second transaction. That's a cash receipt. And cash receipt, you have cash sales of 60%. So we look at are received in the current month. So we go and look at the sales that were made in the month of June. That's how much? How much was sales in June?
$160,000.
60,000.
So 160,000, we subject it to 60%. So do 60% of 160,000.
96,000.
96,000. Thank you. We come and record here 96,000. Then we go to the next one, collection. Now, somebody to read for us so that we don't miss our point. Somebody to read for us that additional point number 2, about 30% and 10%, so that we are able to follow together. Joyce, can you read for us? Joyce, can you read for us? Someone to read for us that additional information so that you conceptualize it and fill in.
30% in the following month.
Yeah.
And the balance is received 2 months after sale.
Okay. So now, because we are in June, so we are going to receive 30% of which month? Are we going to receive the 30% of July, or are we going to receive 30% for May? Anybody who can assist or who can guess?
July.
July. Why do you feel it's July?
Because they have said 30% in the following month.
Yeah, the following month. Anybody who has a contrary opinion? Yes, thank you for the reason. Yes, because the question has told us that the 30% is received in the following month. Is there anybody who has a contrary opinion to that?
Hata kwanza wamesema in 2 months after sale.
2 months after sale, that's now 10%, the remaining 10%. Yeah. So you are in agreement, we take for July. Anybody who has a contrary opinion? So now let me clarify for you. We are in June. For example, we are currently we are in November. Have we made sales for December?
Not yet.
Not yet. So in that case, can we go and request those people who will come to buy in December to pay us our money today, 30%, and you have not sold to them? Is it realistic?
No.
No, it's not realistic. So when you are preparing cash budget, we go backwards. So that means because we are in June, we'll get 30% of May. Then 2 months after sale, the 10% will get 10% for April. Are we together up to that end? I've said
Yes.
we go backwards. So because we're in June, we'll get 30% of the sales in May. So sales in May was how much?
$160,000.
Yeah, so 30% of 160,000.
That is 48.
48,000. So that's what we'll come here and record 48,000. Then we move on. The next is collection. Oh, I had missed this 48 was to be here. 1, 2, 3. Then here was to write 96,000. Sorry. Then this one is blank. So we progress. Now, collection of 10%. Now we go to April. How much was sales in April?
150,000.
10% of 150,000. 10% of 150,000, you get how much?
15,000.
15,000. So that's what we record here. So we move on. Share capital. When did we receive money for share capital? When did we receive money for share capital? Somebody to read for us the additional information on share capital.
Iko hii F.
Yeah, read.
Shareholders at their last extraordinary
Yeah.
general meeting increased share capital by 70,000. And the first call of 40,000 will be received in October 2016.
In October. So that means we are not going to receive this money here. We are not going to receive it here. We can close until October so that we don't keep on referring to that additional information. So we leave. So once we get to October, we'll fill in now that particular information. Civil suit. Hmm?
In October 2016, the company is due to receive 20,000 as compensation for civil suits.
Okay, sorry, I got. So we are looking at civil suits. Oh, somebody to read for us the additional information on civil suits.
In October 2016, the company is due to receive 20,000 as compensation for civil suit.
So that means we can also close and let it will deal with that once we get to October. So we total now add those monies. Add all those monies together.
$159,000.
159,000. So that's the total. Have I exited? Yes, 159,000. So now we go to cash out, pay out. So purchases, somebody to read for us additional information on purchases.
The amount should be that 339,000.
Yeah, read for us additional information on purchases. Joyce, you are reading for us additional information on purchases or somebody else? Rebecca?
Excuse me.
Yes.
Total, my total is
The total is
339.
come up again.
I'm getting my total as 339,000. Don't know where.
339.
I am getting my napata total yangu kama 339.
339. Uh-huh.
Were we
Mwingine?
including the balance
Yes,
brought?
we start with the balance brought forward.
Yeah,
That
then it's
180.
It's 339,000.
339,000. Thank you for correction. Huh? So now we can progress to cash payouts. Somebody to read for us additional information on purchases or suppliers. It's written as suppliers.
Suppliers are paid
Yeah.
1 month after delivery of goods.
Yes, thank you. Suppliers are paid 1 month after delivery of goods. That means because we are in June, we now pay suppliers who supplied the goods in May. So how much was purchases in May? How much is purchases in May?
110,000.
110,000. So we come here.
110,000.
Yes, that's what we record here. 110,000. We go to corporation tax. Somebody to read for us additional information on
Sorry,
corporation
I have
tax.
a question.
Go ahead.
Why is it May yet it is saying it's after 1 month?
Yes, after 1 month. And we are in which month?
June.
Yeah,
June.
we are in June. So what was your opinion? You wanted for us to do which month? Your opinion, then I clarify for you.
July. Suppose they delivered June, then
Okay. Now, I will clarify for you. You remember when we talked about purchases, okay, sales. We said if we are in November, like now we are in November, can we go and claim for people who are going to buy for us goods in December to pay for us today, to pay us today, and yet they will buy in December? Probably don't know if even if they come to buy, so we cannot claim for them to buy. So the same thing, we cannot purport to be paying for purchases we will make in next month. So as much as the question is indicating next month or after 1 month, that means we go backward. We only pay what we had received. So because we are in June, we cannot purport to be paying in July, yet we have not received those supplies. So the supplies we received last was for May. So that's why we pay for May supplies. Is that in order?
Not really. So which month did the supplier deliver the goods?
The suppliers are okay. Because we are in June, now we pay the suppliers who supplied us in May. Now, okay, let me give you a case study, then you'll be able to conceptualize this much easier. Now, because we are in June, we now currently, actually we are in November 11th. Can your landlord close your door in case you are living in a rental unit? Can your landlord close your door because you have not paid rent for December? Is it possible?
It's not possible.
Hello? Yeah? Is it possible, Rebecca?
No, it's not.
It is not possible. But he can close your door if you have not paid rent for you are in November. If you have not paid rent for October, he can close your door. Is that true?
Yes.
Yes.
Yes. The same concept that you are applying, that these suppliers, since we are in June, we cannot pay for suppliers who will supply us goods in July. We don't even if they will supply. Yes, so we only pay for those who had supplied. So in that case, we look at the suppliers who had supplied previously, and that means the month of May.
I get it.
How about you?
Okay.
You are okay now?
Yes.
Okay. So if you are okay, we can progress. Now we go to the corporation tax. Somebody to read for us additional information on corporation tax.
Eco D,
Mm-hmm.
corporation tax for 2015 amounting to 20,000 will be paid on 30th September 2016.
So in that case, we come here to where there's corporation tax, and we close for that month. We close for July. We also close for August. We deal with it once we get to September. So we come to contractor retention. Somebody to read for us additional information on contractor retention.
Contractors' retention monies amounting to 50,000 shillings will be paid on 30th June 2016.
That means we pay for this month 50. Yes, 50,000. Now we go to administration expenses. Somebody to read for us additional information on administration expenses. Okay. Somebody to read for us additional information on administrative expenses. Hello. What's identified with additional information? Go ahead.
Eco H,
Yes, read.
monthly expenses of monthly administration expenses amounting to 33,000 shillings, included factory application share of
4,000.
Yeah,
Preliminary expenses of 3,000.
3,000. So, and I elaborated what is meant by administrative expenses and what is meant by preliminary expenses. So, in that case, we subtract that money so that we know what is paid out as cash. So, that's the 3,000 plus 4,000, that's 7,000. So, we do that 3,000 minus 7,000. How much does it remain? How much remains?
26,000.
26,000. So that's what we record here. Then office equipment. Somebody to read for us additional information on office equipment. Additional information on office equipment.
Office equipment worthy 13,000 will be paid for November 15th.
On November. That means we can close this until November so that it doesn't bother us. We'll deal with it once we get to November. So, as we close this, somebody to get us now the total for payouts, cash payouts. Somebody to get us the total for cash payouts. Somebody to get us the total for cash payouts.
Sorry, I wanted to get at least
186.
There's somebody who had a question. Just a minute.
I needed a clarification on preliminary expenses.
And you are getting lost, Rebecca.
Preliminary expenses. What was it about?
Preliminary expenses. I said these are expenses that we pay at the beginning of the year. And I gave you an example that if you are operating a business, you must have a business permit. Now, for that business permit, you usually pay one-off. It's a one-off fee. You pay in January, up to between January and March. You should have paid your business permit. But now you are paying for the whole year. That permit serves for the whole year. So if you have paid, let's say, 30,000, it's not fair to treat that 30,000 as an expense for January. So you divide that value by 12. So if you are preparing your financial statement, you will be considering that fraction as an expense for that particular month. But now, because you are preparing cash budget, you are only concerned about cash that has been received and cash that has been paid. So that preliminary expense, that's money that had already been paid in January or thereabout. So we are not paying it out in the other subsequent months. So we don't consider it in cash budget. That's why it was subtracted. Then on depreciation, I've said this as it's an accounting expense. Accounting expense, it means we only record them in the books of account, but we don't pay out any money. So that in that case, it doesn't affect our cash budget. Is that clear now, Rebecca?
So what happened to them?
Yeah.
What happened to this amount?
You are getting low, Rebecca.
Okay, it's fine. Thank you.
Welcome. So somebody was had gotten total cash payout. Who is giving us the total cash payout?
186,000.
186,000. Sawa. Now, for us to get the balance carried down, we subtract cash in, cash received minus cash payout. Cash received minus cash payout. So total cash receipt minus cash payout. What do you get?
153.
53,000.
153,000. So that becomes 153. Now, the closing balance of 1 month becomes the opening balance of the subsequent month. So when you go to July, now that 153 becomes the opening balance. Then we repeat the cycle. Also, we are repeating the cycle. So how much was sales in July? How much was sales in July?
170,000.
170,000. So we subject 170,000 to 60%. Which figure do you get?
102,000.
102,000. So we move on to the next month. Because we are in July, now we'll collect the 30% for June. So how much was sales in June? How much was sales in June?
160,000.
160,000. So this 160,000, we subject it to 30%. How much is that? How much is that?
48,000.
48,000. So we move on to 10%. Now 10% we'll collect 10% for May. How much was sales in May?
160,000.
10% of 160,000. 10% of 16,000. Yes. Now we don't have transaction for share capital, don't have transaction for civil suit. So now we add this together. Add the total. Add the total starting with 153,000.
$319,000.
319,000. So we go to cash payout. So because we are in July, we'll pay now purchases for June. How much was purchases in June? How much was purchases in June?
90,000.
90,000. So we don't have corporation tax, we don't have retention, contractor retention, was only a one-off payment, so we can close the other month so that it doesn't bother us again. We come to administration expenses, it will remain the same figure, 26,000. So get the total cash payout. Cash payout, that's simple, 90,000 plus 26,000.
116,000.
116,000. So we get now the closing balance. So 319,000 minus 116. How much do you get?
203.
So we record here 203. Then that becomes the opening balance, 203. So, and we repeat the same cycle.
I have a question.
Go ahead.
Question.
Yes, go ahead, please.
Is the administration expenses, are they occurring across all months?
Yes, they are occurring all months. It has been written monthly administrative expenses. So it's a fixed cost.
Thank you.
Yeah. Welcome. So we progress. How much was sales in August? How much was sales in August?
200,000.
So 200,000.
100,000.
Yeah, we subject that to 60%. You get how much? How much do you get?
120,000.
120,000. We move on. Now, because we are in August, we'll pay, we'll collect 30%. Yes, thank you. We now pay 30% for July. How much was sales in July? How much was sales in July?
170,000.
170,000. So 170 times 30%, how much do you get?
51,000.
Yes, 51,000. Then we go, we'll now collect another 10% for June. We will collect 10% for June. So how much was sales in June? Okay. How much was sales in June?
160,000.
10% of 160,000.
16,000.
16,000. Thank you. So now let's add those money.
Okay, is the first in August at the cash sales of 60%? Is it 120 or it's 12,000?
Yeah, it's 120. Have I written
Okay.
12? No, it's 120. Yeah.
So
How much is the total?
$390,000.
390,000. So, and then we go now to cash payout. So because we are in August, we'll pay for purchases made in July. How much was purchases in July? How much was purchases in July?
90,000.
90,000. So we don't have any transaction pertaining corporation tax. We don't have transaction pertaining contractor. And then we go to administration expenses, which is a fixed figure, 26,000. Now get the total. Get the total cash payout.
116.
Oh, yes, 116,000. Now get the difference, closing balance.
274.
Yes, 274,000. Now this 274,000 becomes the opening balance for September. Opening balance for September. 274. Then we repeat the whole cycle. So we'll do September together, then allow you to do October, November, and December at your own pace. Then we can get feedback next time when we meet. So let's do for September. How much was sales in September?
200,000.
200,000. 60% of 200,000?
120,000.
120,000. Thank you, 120,000. Then we move on to 30%. So we'll collect 30% for sales in August. How much was sales in August?
200,000.
200,000. So 30% of 200,000?
60,000.
60,000.
60,000. So we go to 10%. So 10% we collect for July. How much was sales in July?
170,000.
170,000 times 10%?
17,000.
17,000. So get us the total. 491. 471.
471.
Thank you. 471. We go to payout. So in September, we purchases will pay for purchases made in August. How much was purchases in August?
80,000.
80,000. Then we now have corporation tax. How much were we to pay corporation tax?
20,000.
20,000. Thank you. So because it's a one-off transaction, then we can close the other month. Let's close this other month. It's a one-off transaction, so we have already dealt with it. Then we don't have the corporation tax with the administration expenses 26,000. So let's get the total. The total
126,000.
126,000. We move on to the difference, the closing balance.
345.
345. Thank you. So when you go to October, you will open with that 345,000. So because I've said you October, November, and December, if that's a takeaway assignment, you try on your own, then you can share any feedback you get. But I would like to clarify just something so that you understand why you have collected in those installments. Let me pick a color here. We can start with the cash sales, this and this. And this. Try add those money, those values that I've shaded. Is it that green? Add those values that I've shaded.
$160,000.
160,000. Now go to your cash sales, to your sales for the month of June. Go to your sales for the month of June. Is it tallying up?
Yes.
Yes. Now I've also shaded the other three figures. Go and add them. See? Who is adding up?
170.
170. Is it tallying up to the sales that were made in July?
Yeah.
Yeah. So, and that's now what we are, okay. So you'll also do the other 3 months, then try and add as I've shaded here. And see, those money should add up to that, to the sales for that particular month. And that's because we are receiving 3 installments. So it's the same amount, but now we are receiving installments, and that's how we have apportioned it. So with that, unless if there's any question, I would like to adjourn the class at that moment. If there's a question or two I can respond to, then allow you to do that particular assignment. Is there any question or concern? If there's none, I take this opportunity to wish you a wonderful evening. Let's meet next week, God willing. Have a wonderful evening.
You too.
You too.